Welcome to our monetary policy special. The Reserve Bank today delivered a volley of sixers, typical of a Virat Kohli or a Sai Sudarshan in the just concluded IPL series. It announced a 50 basis point repo rate cut. The market expected 25. And it also announced a 100 basis point cut in the cash reserve ratio, the cash that banks have to maintain as a percentage of their deposits in cash, which they can't lend. Now, the combined impact of these should drive interest rates down considerably by the end of the year, by the end of FY26, and that can boost growth. But on the other hand, like a Rahul Dravid, the Reserve Bank moved back to the crease by changing the stance from accommodative to neutral. What it means is it is probably signaling that it is ending the rate cutting cycle. Now, how much can its steps its easing steps stimulate growth? What will be the future liquidity steps that the Reserve Bank may take, considering that it has already given a 100 basis point cash reserve CRR cut? And what happens to bond yields? What happens to the rupee? For all these questions, I'm joined by an elite panel, three stalwarts. I have with me B. Prasanna, the head of global markets at ICICI Bank, Mridul Saggar, former Reserve Bank of India MPC member and now professor of economics at IIM Kozhikode, and Samiran Chakrabarty, the chief economist from Citibank. Gentlemen, thank you very much for your time. But before I come to you, I want you to hear out what the governor said when I asked him these two questions, for which I was given time. One, what is he going to adjust the liquidity in such a way that the call rate is along with the repo rate? At the moment, until yesterday, the call rate was 25 basis points below the repo rate. So will he align it, was one question. And the other question was, is he signaling that there is no more space for rate cuts given the inflation and the real policy rate? Or is there more space after a pause? Let's just listen to the governor, and I'm coming back with questions.
First question is a very good question. In fact, what do we do with liquidity? Where do we actually maintain now the call rate? The call rate today is hovering at the lower end of the LAF as it was till yesterday. So it was at about 5.75%. Whether we now maintain it at 5.25 or at the policy rate, which is at 5.5. That's, as I said, we'll see how the situation goes. Of course, liquidity is abundant, and if we do not do any VRRs, then it's going to stay at 5.25. If we do VRRs, then, we can bring it anywhere between, depending on the amount. So we'll see, how the situation evolves, and we'll take a call. We have not really given it a thought on that, so we will decide. And you'll come to know, in the coming few days. I'll not be able to give you a very precise answer. But having the policy at 5.5, and the stance, now going to neutral, so all that will, certainly come in the picture. We will take a call as to where, we will try to have the call rate. The second question was on where do we see the terminal rate. The MPC, I think, has very clearly, articulated that in the statement, in the resolution that has come in. We have changed the stance from accommodative to neutral. And it has mentioned that there is now very limited space for the monetary policy, actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation, we are projecting at 3.7% for this year. And next year, it's above 4, it's 4.5%, or roundabout. So given these if these were to play out, there is very limited space, is what, MPC says, and that's why it has been reduced now. We have changed now to neutral.
Okay. See, now let me come straight away to the question that everybody will have. Samiran, is there another rate cut at all? The governor seems to be at pains to say that next year inflation is going to be above 4%. And now we are at 5.5%. So is he practically like 99% ruling out a rate cut?
So, Latha, the way for us to think about it has been that this policy has been very pro-growth policy, and the new set of RBI things that we have seen in recent times also seems to be supporting growth. The way the growth has been characterized has also been lower than aspirations. So purely from a growth standpoint, one can always argue that there is some space for even more rate cut. We also have a lot of uncertainties around the growth number going forward. So we'll have to probably can argue for a rate cut, may not be in the August policy, but in the October policy, purely from a growth angle. But also we have to take into account the fact that when we get into October, the forward-looking inflation numbers, particularly for the Jan-March quarter, for which RBI has put the forecast at 4.4, we think it could be slightly higher also. Then the real policy rate based on that expected inflation turns out to be barely about 100 basis points. And that's where I think the governor is mentioning that there is very little or very limited space for further monetary policy easing. So only in a scenario where that forward-looking inflation also comes down sharply below 4%, then both the growth and inflation combination, one can think of a further rate cut in October, but that's not our baseline scenario at this moment.
Your baseline scenario is no more cuts?
Yes, that's the scenario. That's the thing. But yes, we have put it very carefully in our report that if at all a rate cut can be considered, that's not before October.
That is not? Sorry? If you, I didn't hear your last line.
No, I was saying that if at all a rate cut has to be considered, that cannot be before October. August will be too soon.
I want to ask all three of you, is there a 5-quarter of repo? Prasanna, do you see a 5-quarter at all?
So I think, Latha, even before the policy, our terminal repo rate was for 5.5, and with liquidity easing, taking the interbank rate lower to 5-quarter to 5.35. But of course, we thought that it will happen over two policies, this policy as well as the next policy. I think what the governor has done is to use up all the ammunition that he has in this policy. And that is also one of the reasons why he has shifted from the stance from accommodation to neutral. But having said that, see, this is the stance at this point of time, and this is his view at this point of time. There are 2 or 3 things which can happen, which can potentially make the 5-quarter repo possible. One of it is, of course, like Samiran was saying, inflation estimate coming down drastically. If there is a further incremental downward surprise in inflation. The second is, of course, if growth were to take such a hit that the push towards potential growth needs that much more thing, and it requires a lower real rate of interest. Today, if you can argue 370 plus around, say, 170 comes to 540. So real rate, the repo rate is very safe at 540 to 550. But if the growth were to take a hit, then, real rates can come down. And the third is, of course, if Fed were to cut rates. Now, at this point of time, we think that getting even a 25 basis point, we'll be lucky if Fed cuts this, right? But that can also change going forward. So these are the 3 things. Having said that, at this point of time, we do feel that the next couple of policies are possibly going to be a pause. At least the next policy is going to be a pause. And then we'll have to see how incremental data falls. I think the RBI has now become truly data-driven.
Okay. No, I'm a little surprised by your answers because in my book, when I read, I went with the expectations of more. But after his speech and his answer to me, I thought he had blocked, like 99% no more rate cuts. Did you get that impression, Mridul? That's why I played that bite.
Latha, I did get that impression, to be honest. It does look that the RBI seemed to have used up all its ammunition. So this was a very unique sort of policy, extraordinary, unusually activist. And what we are seeing is that they have introduced a monetary policy surprise along with monetary policy uncertainty getting reduced. So you have added a surprise on the one hand, and you have reduced the uncertainty going forward about the monetary policy. Now, the bond markets apparently haven't liked that. The bond yields haven't really softened at all. They moved a bit north. So one has to wait and see what the outcome is. But at least till the October policy, I don't see any chance of a rate cut. December, only if forward-looking data is dramatically different from forecasts what it appears to be in RBI's mind. The crunch would really come at end March. That's sort of number of inflation, expected inflation being 4.4% projection. So if there is a downward surprise, then it opens up some room for further cut. Or if growth slumps dramatically from 6.5, if global condition extraordinarily deteriorates, that's only the possibility. Otherwise, it seems RBI has used up the ammunition because they have done a 50 basis point, and with a real rate of 1.1%, given the Q4 inflation expectation, what they put out projection, so it becomes like real rate of 1.1%. Now, compared to 1.65% neutral rate midpoint estimate of the RBI, it means the policy is already accommodative. So that really takes up the room, and therefore the chances of cuts are very dim. It requires fundamental change in forward-looking data.
Yeah, okay. I would more align to that. I can't see a cut from the language used by the governor. Prasanna, now to come to the other point that should be plaguing the market. Do you think going forward, the governor did not give a clear answer, I thought, but what is your sense? Is he going to keep the call rate at 5/4 or at 5/2?
So before that, Latha, I think one that we need to recognize is that this is, you have to describe this policy as one for the real economy and for the multiple stakeholders at large, because it's going to lead to lower EMIs and lower borrowing costs, but not necessarily for the financial markets and the bond traders who always want the carrot to be dangling in front, that in some time there will be another rate cut and all that. So I think to that extent, I agree with what Mridul had to take away. But in terms of your question on the liquidity front, Latha, I think the stance, I think the governor has clearly indicated in the previous policy that the stance is related to the interest rate movement that we expect to going forward. So he has delinked the stance from the liquidity part of it. Having said that, if you want to keep surplus, so there are two things when you come to liquidity. One is, are you keeping surplus or deficit, and what is the extent of surplus or deficit liquidity that you want to target? And the second is, what is the price of that marginal liquidity? So while the first part has always been a part of active RBI enunciation, like whether they're going to keep it surplus or deficit and how much, like for example, the previous policy, he did, I think, tell you that he is targeting 1% of NDTL as surplus liquidity. Yeah, but the second part, which is what is the price of the marginal liquidity, is never publicly stated by the Reserve Bank. And it is always deduced by the kind of actions that they do, whether they do VRRs to suck out liquidity, whether they do VRR to give liquidity, and so on and so forth. So that is why I feel that we are not going to get an answer from RBI in so many words over the next days, that they will keep liquidity in order to get the interbank rate to 5/4. I think you need to deduce it from a series of actions that they will do over the next 10-15 days. My guess is, despite the answer that he gave to you today, my guess is he will continue what he has done in the last 2 months or so, which is in effect means that let the liquidity remain in the system so that SDF or closer to the SDF rate becomes the operating rate, rather than, take money out using VRRR and bring the rate to repo rate. Because if he does that, then what is he actually achieving? He did at 50 basis points, but he's taking away 15. So then it becomes a 35 basis point rate cut. So I think we are splitting hairs then. So my prediction at this point of time is to believe that he will not announce VRRs to aggressively take out the surplus liquidity and let the interbank liquidity find a pricing between 5/4 and 5/2. But of course, if he does it, then I'll be proved wrong. I'll be watching for those moments.
Yeah, actually, even I don't know how to guess. He left us guessing. But Samiran, besides the liquidity, which he can always squeeze out with a with a reverse repo, there is also the CRR liquidity that will come, and that is a substantial amount of liquidity, 2.5 lakh crore, that will start coming from September to October. So do you see that actual lending cost of banks is going to fall rather sharply? That is one question, and therefore, do you think there is an upside surprise to everybody's growth forecasts?
To start with, I think our own growth forecast at 20 basis point higher than RBI's forecast at 6.7, because we think that there is a substantial amount of monetary stimulus that has been given to the economy in a short space of time. And as we move in the latter part of the year, this monetary stimulus should show up in the activity data as well. In fact, we thought that there was a possibility that RBI could have raised its forecast even in this policy itself, but maybe they decided to see some more high-frequency data before changing those numbers. So in short, I think this policy is going to work in stimulating the growth numbers. Maybe that's why our inflation forecasts are also slightly higher than RBI's inflation forecast, particularly for Q4 of this year. Now, how quickly this gets translated into lower lending deposit rates, that's a tougher call because historically the lag between the MCLR and the 10-year bond yield has been of about 6 months or so. Now, this time around, as Prasanna was mentioning, that the bond markets have reacted slightly. The 10-year bond yield has slightly actually gone up. The term premium has started expanding quite fast because of this expectation that we are already at the fag end of the rate cutting cycle, if not at the terminal rate. And that's where the MCLR transmission might have to be much faster now, because the EBLR transmission will work much quickly, as we know, in the current setup. So our estimate is that only the EBLR kind of move itself, that whole 100 basis point, if it gets translated into the average cost of borrowing coming down by 100 basis points, that's about 40 basis point of GDP impact on the household balance sheet in a positive way, which should play out. And then on top of it, this should lead to banks lending more to even NBFCs. So the overall banking and NBFC credit improving could add more to that overall stimulus. So with a 6 to 9 month lag, I think this should significantly start affecting the consumption demand is what our sense is.
Wait, you have raised your growth forecast, correct?
We were at higher than RBI's number even before this policy. It's just because, we all anticipated.
You mean you were at 6.7 even before the policy?
Yes. We thought that this overall 100 basis point rate cut would have a positive effect on economic activity. The only question for which we don't have a good answer is that what happens to this durable liquidity surplus?
Okay.
Because in our view, this durable liquidity surplus stays in the system for almost the entire year, at least till December. And how that gets translated into the non-real economy variables, the financial market variables, that's something which we have to observe now more closely, because if the real economy cannot absorb this additional liquidity through higher credit demand, then will there be any spillovers into financial market excesses? That's the area that we need to watch now more closely.
Yes, there can be an accusation that the Reserve Bank has been perhaps more generous than it should have been. That accusation stands, at least from some economists. I have to take a break, but since you spoke about external benchmarks and therefore banks' loans immediately becoming cheaper, let me leave you with the soundbite we got from C.S. Setty, the chairman of State Bank of India, who believes there'll be a sharp cut in their margins in the earlier part of the year, and then an equally sharp rise in their margins because money will become cheaper for them because of CRR cut. Hear him out. We'll take a break and be back.
There will be a U-shaped curve in terms of the NIM movement, in my view. It will, there will be a reduction in the margins, and then we'll pick up as we move towards Q4.
Welcome back to our Monetary Policy Special. I have been discussing this rather surprisingly bazooka rate cuts and CRR cuts that we got with B. Prasanna of ICICI Bank, Mridul Saggar, formerly of Reserve Bank, now with IIM Kozhikode, and Samiran Chakrabarty of Citi. Gentlemen, thank you very much for your patience and for staying on. Mridul, I wanted to ask you exactly what I asked Samiran as well. Because of this ultra-easy policy, are you seeing an upside surprise to your own growth numbers?
Yes, but in short run, yes, it could create a bit of support to the asset prices, which will then feed into sort of higher growth numbers. But it will also probably hit the inflation numbers at some point. This is the amount of liquidity which is being infused is pretty large. I mean, we were
Mridul,
at surplus liquidity.
One minute, Mridul. Like Samiran, you are also expecting an asset inflation in that case.
I do. I thought you were asking Samiran now.
No. I'm asking you.
Okay, me. So I do expect it to have some impact on at least equities and real estate in particular. So that would then probably, if we don't get that much of effect on real economy, the capacity utilization rates now are marginally above the long-term trend, and ordinarily it would have kicked in some investment. But given the uncertainties which exist globally at this juncture, it will be hard to kick in investment cycle at this point of time. So essentially some consumption boost will come through. But eventually what I fear is that if you move on to 7 or 8 lakh crore of durable surplus liquidity once the CRR cuts get effected, so I do not know if the forward positions would take that off substantially, their unwinding. But if that kind of situation occurs, it will have some impact on inflation going forward towards the end of the year.
Oh, so that's important. That means the governor and the RBI has probably been more generous than it ought to be. That argument, that criticism can come if things pan out in a certain way. Prasanna, a more sedate question. What is your sense of bond yields? Where do you see the 10-year benchmark itself going, and any impact at all on the rupee?
So I think, Latha, before that, very quickly on the liquidity front, since he has done the CRR cut from September, you have to assume that he's planned it in such a way that when the outstanding bond forward positions are maturing and that sucks out liquidity, that's when this liquidity will come in. So you have to assume around $40 billion of forward outstanding can mature, which can kind of offset the kind of CRR cut, the liquidity infusion through the CRR cut. So I think RBI has possibly thought it through and wanted to give certainty to the banking system that even in the second half, don't worry, we are going to be in a surplus, but maybe not that much as what we are fearing right now, but much lesser, but still a surplus nevertheless. On the bond yields, Latha, I think the curve has done a very interesting twist today. The short end has fallen. The 10-year has gone up marginally in terms of yields, and the long bonds have gone up even more. So I think we are going to see a typical steepening of the curve as we go forward, because like we all rightly discussed so far, we are not really sure about the next rate cut anymore. It is completely data dependent. So there is no carrot dangling in front of the long bond trader. So to that extent, I think you're far better off assuming that the surplus liquidity will keep your borrowing cost lower. So I'm better off investing in the shorter end of the curve, maybe up to 8 years, 10 to 10 years, rather than the really long part of the curve. So the bond yields are not likely to move much lower beyond maybe 610 or 615. I would call a range of between 615 to 635 as a range for the next 2 to 3 months. As far as rupee is concerned, while a rate cut is actually negative for a typical economy, I think the way the market read it today is that it's a very equity positive kind of a policy because it really makes matters quite positive from the real economy perspective. Like I was mentioning earlier, that the rate starts filtering in right from tomorrow when the EMI start coming down and the corporate bond borrowings start falling. So to that extent, if equities are going to be positive and the fact that the CRR cut actually leads to an increase in money multiplier and the ability of M3 growth to sustain a much higher GDP growth, the conditions for that has been opened up. So from that perspective, if equities were to become positive, then maybe capital flows can come in during the second half of this financial year, or maybe slightly later, and hence it's slightly positive. Nevertheless, I think we go with a range of around 85 to 84.5 to 86.5 kind of a range.
Okay. Actually, out of time, but Samiran, I'm squeezing two very quick, if you can give me monosyllabic answers, if possible. One, do you think that, did you hint at asset inflation? Is that a fear? And secondly, will you now say that credit growth could be like 14-15% this year?
Not that much of credit growth at this point of time. And on the asset inflation question, yes, we have quoted that both asset inflation as well as any sign of pricing power for corporates, we will be watching both these signs more closely now than we were earlier.
Okay, again, a brief answer from you, Mridul. Do you think they have been a little recklessly optimistic?
I wouldn't say recklessly optimistic. It is a bold experiment. We do not know whether it will succeed or not succeed. But I think it's moving away from conservative central bank sort of dictum. And there is an element of risk which has come in with the more than expected monetary stimulus.
Okay. Yeah, I have not seen a 100 basis point CRR cut in normal times. As well, we have got a double repo cut. So, yes, we have to be cautious that this can be, we are running faster than we are capable of. And therefore, is there a fall ahead? That danger exists, but otherwise, at the moment, in the short run and the medium term, there is a very good growth prospect that we are staring at. That's the message from the experts. I think I've understood them well. Samiran, Mridul and Prasanna, thank you very much for joining me in this monetary policy special.